Hi folks, hopefully you are well. They often say, don't they, that a week in politics is a long time. Well, a week in the stock market, the financial markets, is certainly a long time. The last week has seen a massive move higher in global stocks. And we know why, don't we? Clue is on the board there. We'll talk about that in more detail, but let's just show you what's been happening in the financial markets. Now, this is the chart of the Dow. This is a 4-hour chart. Each candle represents 4 hours worth of price action. Back on election day, November the 2nd, the Dow was trading back down there at around 26,150. Since the election, we've shot up, hit 30,000. That has been a 15% increase in stocks, the main stocks in the US, in just one short week. This is the DAX. The DAX is the German stock market. So the top 30 companies that are traded out in Germany, the same type of price action. Stocks have basically risen almost 17% in the last week. This is again a 4-hour chart of the DAX. You see, since the election, a massive explosion in the stock prices. I just want to show you a chart here. This is the S&P 500. Now, the S&P 500 is the top 500 companies traded out in the US. Now, this is a daily chart. Some of you may be familiar with this. Certainly, if you are holding stocks at that level, you'll be familiar with this. This is basically back in March when the coronavirus basically kicked in. The stock market plunged over 30% down to the low there in, say, mid-March. Since then, stocks have been on a tear with a lot of people fearing that a vaccine will be found at some point and that the stocks will explode. This is the FOMO trade, the fear of missing out, taking this much higher. And again, since the election, we've seen this big move and it's likely to go on higher again. So what has been driving these stocks higher? Well, it basically comes down to two main events that have collided with each other. First off, you've got the Biden victory. So Joe Biden has won the presidency. He will take office in January 20. Or will he? Donald Trump has obviously got things to say about that. He's calling election fraud. He's calling it to the Supreme Court and so forth. Now, I don't live in the US. I'm not on the ground. I don't really have a view on it. Well, I might have, but I'm not going to give my view now. Certainly don't want to lose half my subscribers. But nonetheless, the markets are perceiving this Biden victory as a time to buy the financial markets, buy the stock market. Remember, I spoke about it in that video that I did in the debates just before the election, talking about the stock market possibly doing well under both Biden and Trump. Well, now it looks as though Biden won't gain control of the Senate. This basically means he's going to have trouble getting through his punitive tax rises on the rich and the corporations and so forth. So the corporations are now looking quite attractive. So the stock market is getting bought up on the fact that maybe there's more global stability with the United States and the fact that these tax rises won't go through. So there's a big buy momentum on the back of the Biden victory. And of course, the other main event this week is that there seems to be a breakthrough in the coronavirus vaccine. Pfizer have announced that they have a 90% success rate in one of their stage 3 trials. The market is absolutely loving it. This is one of the main reasons why the stock markets went up 5, 6, 7% in just one trading day. So now we've got a potential virus vaccine. That's going to be great for the global economy, not just least the US economy, but the global economy. And you've got a more stable US as well, with less taxes for those corporations. You mash all those together and you're going to get this explosive move in the stock markets, exactly what we're seeing at the moment. Now, as you know, all markets around the world are linked. They're all linked together in one way, shape or form. As you also know, the Forex market, the currency market, is the largest financial market on the planet. They say it's got a turnover of over $7 trillion. I don't know if that number is true or not, but it is the biggest market out there. It certainly has the biggest turnover on a daily basis. So all these market movements that you're seeing, whether it's the commodity markets, the stock markets, they all have implications on each other. So now I want to talk to you about the implications that the stock market rally is having on the Forex market. And I want to introduce you to a term that I often talk about in my trading room, and that's risk on and risk off. So what is risk on, risk off? I hear you cry. Well, it's quite simple really. If you're an investor and you are confident about an economy, confident about a particular country doing well or so forth, the global markets, then you want to take on more risk. And how do you take on more risk? Well, you get involved. You start investing. You buy into companies that should do well. And of course, if the company does well, they're going to make profits, and you want to be part of that profit cycle. So you're buying the stocks. If you're buying the stocks, the stock market goes up. And that's exactly what the fund manager is doing as well. If they want to take on more risk for their pension account holders, then they start to buy the stock market, because the growth in the stock markets can be much more than you get in, say, other investments. So the stock markets will go higher in times of risk on. Now, in times of risk off, say you're concerned about the global pandemic or hyperinflation or something like that, then of course you start to think, well, hang on, I don't want to put my money at too much risk. I'll take it out of those risk assets. I'll take risk off the table, and I'll keep my money under my bed, under the pillow, or what have you. Or you might want to invest it into another instrument, maybe the bond markets. Bond markets briefly are basically loans to corporations or to governments, and these governments or corporations have promised to pay you back the initial investment with interest every 6 months or every year or so forth. That's basically considered to be a less riskier asset than investing in the stock markets, because a bond is basically an IOU. They will pay you back. Well, maybe not in Zimbabwe, but they will generally pay you back. So basically that is risk off. So you're selling the stocks and you're buying less risky assets like the bond markets, or you're sticking your money under the pillow. Now this risk on, risk off has direct implications on the currency markets, and I'll show you exactly how that works. So we've established the fact that risk on, stocks will go higher, and risk off, stocks will go lower. Now, typically speaking, a fund manager, a big investor, if they want to buy the stock market, they will borrow money and then invest that money. And the best place to borrow money, of course, those currencies or those countries that have very low interest rates, such as Japan, Switzerland, Europe. These all have negative interest rates. So basically what a fund manager will do, very broadly speaking, is that they will borrow the Japanese yen on the financial markets. They'll borrow the yen, then they'll sell the Japanese yen on the financial markets to buy the US dollar or the currency that they want to use to invest in the stock markets. So that basically means the yen is going to be sold. The yen is going to be sold, the yen will go down in value. Same really for the Swiss franc or indeed for the euro. So when the stock markets are going up, the low yielding currencies that I just mentioned, they will go lower. Typically speaking, it doesn't always work like that. And the commodity currencies, those currencies that basically do well in times of risk on, when the economies are expanding and growing, currencies like the Australian dollar, commodity currency, iron ore, copper and so forth, big exporter, they will do better in times of risk on, in growing economies. So the Australian dollar will go better. The Canadian dollar, heavily denominated or heavily related to the oil price. Growing economy, growing oil prices, that basically means the Canadian dollar will go higher. New Zealand dollar, agricultural, machinery and so forth, food produce, that will go increase in value in times of risk on. So those are the risk on currencies. Now of course, when everything shifts and it goes the other way and markets are coming back down, well then investors, fund managers, they're selling their stocks. They're selling their stocks, and they basically need to now repatriate all these yens that they've basically lent out to the market or sold in the market. They've got to now buy that yen back. They've got to buy that yen back to repay their loan. If they're buying the yen back to repay their loan, what happens to the yen? The yen goes higher. So the Japanese yen, the Swiss franc, the low yielding currencies will tend to perform better when the markets are coming back down, as there's repatriation of those initial loans. So here's a basic summary of all that. So remember, risk on, stocks go higher. That is bullish for the US dollar, for the Australian dollar and New Zealand dollar and the Canadian dollar. So these should go up in value when the markets are trading higher. And of course, the currencies that you may look to sell on a market that's risk on would be these low yielding currencies, the Swiss franc, the Japanese yen and the euro, as well as gold. Gold's a funny one. Gold has basically been very much a hedge against the stock market in recent years. Now, over the last 6 months or so, since COVID kicked in, it's actually been going in tandem with the stock market. You remember when the stock markets crashed in March of 2020, gold markets crashed as well. Gold markets crashed as well because people had to sell their gold positions to pay for margin calls on their stocks and so forth. But this time around, with the stock market rallying as to these new time highs that I've just been talking about, the gold markets have been coming back down as well, as investors are selling their gold positions now to buy these risk assets, these stocks. That's basically coming back into where it should be, although it did have a bit of a negative correlation for a while. So that's risk on, stocks go higher. Again, risk off, that basically means the currencies that should do better will be the Swiss franc, the Japanese yen, the euro, and the gold. And of course, risk off basically means that these currencies, the Australian dollar, the New Zealand dollar, the Canadian dollar, US dollar, these are the commodity currencies as well. These will underperform in times of risk off. If economies are contracting, if businesses are not making any more profits, they don't need to expand, they don't need all these raw materials that basically are provided by these countries. That's basically risk off. And if you look at this chart, this is something that I look at each and every day in our trading room. I took this screen grab about half an hour ago before I came on camera now. This is a daily chart. I know it looks all confusing, lots of wiggly lines and all that, but it basically tells me a picture. I can look at that at an instant and tell you that the stock market is going higher. Why? Because I'm looking at these currencies down here. That's the Swiss franc and the Japanese yen. So those currencies are being sold, they're coming back down. Look at the direction of the line, they're coming back down like that. These are these currencies here, the Swiss franc and the Japanese yen. This light blue line here as well, that's basically the euro as well, that is coming down. So these low yielding currencies now are coming down. The high yielding currencies, or the commodity currencies I should say, you got the Canadian dollar, Australian dollar, New Zealand dollar, all heading up. The pound's up there as well this week as well because of Brexit. But you see here the New Zealand, Aussie and the CAD all doing strong. This is a classic case of risk on. Money is flowing into the stock market and these currencies are being sold on the FX market. That's basically what you should be looking for when you see times of risk on. So if you're buoyant about the economy going forward, if you're confident the economy is going to be great into 2021, you should perhaps be looking at these low yielding currencies as the ones you may be looking to sell on a longer time frame, and the commodity currencies there as well. This is a chart showing the S&P 500. Now that's the top 500 companies that are traded out in the US. It's basically a look what's been happening over the last 50 years or so. Okay, now a bear market is a market that basically corrects to the downside by 20%. Obviously it's a bull market, up by 20%. And what this chart does, I put this together, in fact my daughter put this together, it basically tells me the extent of the bear market, how long we were in the bear market for, and how long it took to recover. You'll see here that every bear market that we've had since 1973, we've surpassed and hit all-time highs at some point down the line. So here we got the January 1973, the S&P 500 dropped by 45%. It was down there in the bear market conditions for 21 months. It took 69 months to get back up to where it was before the bear market took hold. I think that was the breakdown of the Bretton Woods in 1973. August 1987, I think that was the first bear market that I witnessed as a trader myself. I remember I was trading on the London Stock Exchange at the time. We had a bear market of 34% on the S&P 500, down there for just 4 months. And it took 20 months to get back up to record highs, surpassing where it was. And then March 2000, we had a bear market of 49%, 31 months it was there. Took almost 5 years to get back up to where it was before. We all remember the October 2007-2008 financial crisis. Saw a 56% drop in the S&P 500. Took 49 months to recover. And this one, March 2020. Well, we all know what that was. That was the COVID pandemic, and the stock market's S&P 500 dropped about 38%. A lot of traders were rushing to the doors on that one, and it's basically recovered. We've now hit all-time highs, and it's taken just 5 months to get back up there. So you can see here that all these stock market bear rallies we've seen in the past, we've always seen a rally to higher levels at some point in time. There's definite a mood out there now, I think, for the stocks to have a good 2021. You've got a whole bunch of reasons why the stocks may do better in 2021. Potentially, we've got a groundbreaking vaccine. We've got Biden in the presidency, we've got the Fed, we've got global central banks offering money at such cheap levels that the stock markets can only really go, I think, one way at this moment. Not investment advice, it's only a personal view. I might be in and out of the financial, of the stock markets various times over the next year or so, but that, I think, is fair to say would be quite a well thought out bias. And now you know how to trade the FX markets on the back of it. If you're seeing the stock markets booming, if you're seeing the stock markets rallying on a particular day, if there's lots of good news out coming up, maybe you should now be better equipped to trade the Forex markets on the back of it. You remember, risk on, you buy the commodity currencies, and risk off, you sell the commodity currencies. And of course, the low yielding currencies will go well with that as well. Low yielding currencies will do better in times of risk off, and low yielding currencies will do worse when the markets are flying. Okay, that's about it. Hopefully you learnt something there. Don't forget now to leave a comment. Don't forget to follow us on all those socials as well. Don't forget to follow us on Facebook as well. If you follow us on Facebook, you can tune in live every Monday afternoon, 2 p.m. London time, for a live event where we discuss trading opportunities for the week ahead. Okay, I'll see you in the next video. Take care.